So the economy is weak. You can see it in the economic data. You can see it in the earnings. And so now it's showing up in the foreign exchange markets. It's showing up in the stock market. Overall, the dollar was relatively flat on the week. Gold had one big down day yesterday. It was down like $50 or something. It recovered about $20 today, so it finished the week down 0.5%. So not that much. That knocked the gold stocks down about 2.5%. So I think the sentiment is turning. I think there is some buying coming in because gold stocks are value stocks. They're defensive stocks.
Gold prices have recently experienced a noticeable rebound, climbing 0.80% to $2,385 after hitting a two-week low of $2,353. Following a softer-than-expected inflation report, this recovery comes amid market speculation that the Federal Reserve might consider lowering interest rates at their upcoming September meeting. This report hints at a cooling economic environment, which could create favorable conditions for rate cuts. Despite recent volatility, renowned economist and financial commentator Peter Schiff views the current dip in gold prices as a strategic buying opportunity. As the CEO and chief global strategist of Euro-Pacific Capital Inc., Schiff emphasizes the resilience of gold stocks, which have remained strong even as the metal's price has faltered. This resilience suggests a shift in market sentiment, with gold stocks increasingly seen as attractive value and defensive investments. The dollar remained relatively stable while gold experienced volatility, dropping $50 in a day before recovering. Despite this, gold stocks only fell by about 2.5%, indicating a shift in sentiment toward gold as a defensive asset. Historically, gold stocks would see a more significant drop with such a decrease in gold prices, but the current trend suggests some buying interest due to their perceived value and defensive nature. In their next meeting, Peter anticipates mounting pressure on the Federal Reserve to act decisively, potentially cutting interest rates by 50 basis points. He believes the Fed may act swiftly to avoid any perception of political bias as the election season approaches. Recent economic data has intensified expectations that the Fed might use its upcoming meeting to signal a potential rate cut as early as September. This anticipation is expected to drive significant market dynamics in the coming weeks. If the Fed does signal a rate cut, it could lead to increased volatility in financial markets, affecting everything from gold prices to stock valuations. We will present clips from Peter Schiff's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
So the economy is weak. You can see it in the economic data. You can see it in the earnings. And so now it's showing up in the foreign exchange markets. It's showing up in the stock market. Overall, the dollar was relatively flat on the week. Gold had one big down day yesterday. It was down like $50 or something. It recovered about $20 today, so it finished the week down 0.5%. So not that much. That knocked the gold stocks down about 2.5%. I think in the face of yesterday's sell-off, when gold was down about 1.5% in one day, the gold stocks weren't down that much. They were down 2.5%. So, I remember days that gold was down 1.5%. The gold stocks were down 6%. So I think the sentiment is turning. I think there is some buying coming in because gold stocks are value stocks. They're defensive stocks. They should be bought. But, I noticed a lot of the stocks that I own that are defensive in our portfolio. Tobacco stocks, British American Tobacco made a 52-week high today. Consumer staples, Unilever, another stock in our portfolio. Good earnings, up, I think, about 8% the last 2 days, closed the week with a new 52-week high. So some of these stocks that we have in our managed accounts and our mutual funds that are defensive in nature, we're hitting new 52-week highs. That's why even though gold stocks got beaten up pretty hard this week, and we have gold stocks in my value fund and my value fund and my dividend payer fund, both those funds outperformed on the week. Both the funds were positive. even as the S&P went down, because of the gains in the defensive stocks, as we're getting this rotation out of momentum into value. Now, the question is, how much longer is the Fed going to sit on the sidelines and allow this scenario to play out? I don't think much longer. I think there's a lot of pressure building now on the Fed to cut rates, and maybe not even a 25 basis point cut. Maybe we'll get a 50 basis point cut at the next meeting. Because if they don't cut at the next meeting, now you're really kind of getting closer to the election. And there may be some pressure on the Fed. Oh, you can't cut. This is just political. Of course, if they cut now, I think that's political too. But I do believe, as all Fed chairmen do, they owe their allegiance to the last guy that appointed them, which in the case of Powell is Biden. Even though Trump initially put him up on as Fed chair, Biden renewed his term, and the Democrats are the incumbents. And even though Biden isn't even running for re-election, Harris is. I think he's still a team player, unfortunately, despite all the talk about Fed independence. So I think the time for Powell to do a politically opportunistic rate cut is at the very next meeting. And I think he has enough data, this phony data, that he can hide behind to try to justify the rate cut. He can say that, the inflation rates are down. They're down 2.5%, which, that's close enough. It's not quite 2%, but, we're almost there. We're on a glide path. He could see the uptick in unemployment, the increasing number of weekly claims and all the other weak data. And he could say, look, we need to get ahead of this. We need to, move with a rate cut. So I think there's a very good chance we'll get that rate cut, and maybe that will change the dynamics in the market. But I think without a rate cut, if Powell keeps claiming that, no, we're going to be vigilant, everything is great, the economy is strong, we're going to keep rates high, I think he risks the potential of a stock market collapse.
Recent economic indicators reveal a steady deceleration in the U.S. economy, largely attributed to a slowdown in consumer spending. Since consumer expenditures drive about 70% of the nation's economic activity, this shift is noticeably affecting overall growth. This moderation is reflected in recent GDP growth numbers, which fell from a strong 4.9% in Q3 2023 to a more subdued 1.4% in Q1 2024. Although forecasts by FactSet suggest a possible uptick to approximately 2% in Q2, this still indicates a persistent cooling trend. Experts have noted that the decline in consumer spending is not uniform across the board. It seems more severe among low and middle income groups. Instead of halting spending altogether, these consumers focus more on finding deals, suggesting a shift towards more budget-conscious behavior. Yet, some observers, such as economist Peter Schiff, interpret these trends with concern. Schiff argues that this might lead investors to rethink the probability of a smooth economic transition, or soft landing, where inflation is managed without causing a recession.
In the foreign exchange markets, we saw a rather sharp rally in the beaten down Japanese yen. The Japanese yen was sitting at, 30 to 35 year low or something like that. The yen got up to 161. And when I say up, I mean down, because you could buy 161 Japanese yen for a single dollar. And again, you haven't been able to buy that many yen for your dollar in about 35 years. And we had a big rise in the yen. I didn't hear anything about Bank of Japan intervention. It's always possible that that was going on behind the scenes. I don't know. But the yen closed the week at 153 3/4. That was a huge move for the Japanese yen. It took some toll on Japanese stocks. They got beat up pretty bad with a strong yen. From the perspective of a U.S. dollar investor, it was probably a push, right? The yen went up. Japanese stocks went down. So in dollar terms, there wasn't much action, but there was certainly a lot of action in Japan. But at the same time that the Japanese yen was moving up, the Swiss franc also had a pretty good gain against the euro and other currencies. And on the flip side, the weakest of the major currencies was the Australian dollar. Just got clobbered. Pretty much relentless, down every day, except it gained a little bit back today. I forget what it dropped on the week, maybe 2-3%, but that's against the dollar. Much bigger drop against the Japanese yen. And I think a lot of the trading was spread trading. I think that people were unwinding some bets that they had made, maybe long the Australian dollar and short the yen. And the reason this is significant is normally when you see yen buying and Aussie dollar selling, it's because investors or traders are looking for a slower economy, because the yen is perceived as a safe haven, even though there's really not much safety in the Japanese yen at this point, but it is still a risk-off a kind of currency, a funding currency and a risk-off currency. And the Aussie dollar is more of a risk-on, because Australia, their main export is raw materials, iron ore, energy, stuff like that. That's the kind of goods that, you need when your economy is strong, particularly the Chinese economy. China imports a lot of raw materials that it incorporates into its manufacturing process. And so if you think there's going to be a global slowdown, there's going to be less demand for goods, raw materials to make the goods. And so you see weakness in the Australian dollar. What's happening here is investors are starting to price out the soft landing hypothesis, and they're bracing for a hard landing. And a hard landing meaning a recession. Now, of course, I think we're in a recession. Certainly manufacturing has been in a recession pretty much for the entirety of the Biden presidency, which is why it makes me so mad every time I hear Joe Biden talk, to the extent that he can talk. And he talks about the booming economy, how great manufacturing is. Of course, Trump said the same thing, and it wasn't true when Trump said it, and it's not true when Biden says it, but manufacturing has been terrible. And all the manufacturing data that came out this week was all bad, right? Everything was worse than expected. So the manufacturing's been in a recession. I think the whole economy is in a recession. It's just not officially in one because the numbers aren't accurate. But I think that investors are bracing for an official recession, meaning a recession that's so bad that you can no longer hide it beneath the rigged numbers.
If the Federal Reserve cuts interest rates, we could see a significant impact on gold prices. A rate cut would lower the opportunity cost of holding gold, making it more attractive than interest-bearing investments. Additionally, a weaker dollar resulting from lower rates could boost global demand for gold as it becomes cheaper for holders of other currencies. This scenario suggests a potential rise in gold prices as investors turn to gold as a safe haven amidst economic uncertainty and market volatility. Share your thoughts on Peter's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.